Welcome back to SNB Experts Learning Platform. Today, we begin a truly transformative session, Module 8 on Behavioral Finance and Market Psychology. We will explore the human element of investing, why even the smartest professionals make predictably irrational decisions, and how you can avoid these common pitfalls. Our roadmap for this module is comprehensive. We will start with the foundations of behavioral finance compared to classical theory. Then, we dive deep into cognitive and emotional biases, examine the mechanics of asset bubbles and crashes, and finally, build a systematic, deviate investment process. This journey will change the way you look at market data and your own decision-making process forever. Classical finance assumes investors are fully rational and markets are always efficient. Behavioral finance, however, acknowledges that we have bounded rationality. Our biases cause systematic errors, leading prices to diverge from fundamentals. Understanding this gap is the key to earning alpha in an irrational market. At the heart of this field is prospect theory. Nobel Prize-winning research shows that people evaluate outcomes relative to a reference point, usually the purchase price, rather than in absolute terms. This anchors every subsequent decision. More importantly, we experience loss aversion, where the pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. This asymmetry drives a wide range of investor irrationalities that we must master. This 2-to-1 ratio means investors will irrationally avoid any loss, even when the expected value strongly favors accepting it. In your own trading, you may have felt this urge to hold on to a loser just to avoid the pain of realizing the loss. This is the first bias we must identify and correct. Loss aversion leads directly to the disposition effect, the tendency to sell winners too early and hold losers too long. This is the exact opposite of optimal, tax-efficient investing. To fix this, you must harvest your losses and let your winners run. Ask yourself, would I buy this stock today at this price? If the answer is no, then you should sell it, regardless of what you originally paid. The purchase price is irrelevant to your forward-looking decision. Perhaps the most dangerous bias of all is overconfidence. Over 90% of fund managers believe they are above average, which is statistically impossible. This illusion of superior skill drives excessive trading and ultimately leads to underperformance. We must recognize our own limitations to survive. Overconfidence manifests in several ways. The better-than-average illusion leads to overtrading, while the illusion of control makes us confuse luck with skill in rising markets. We also see miscalibration, where analysts set confidence intervals that are far too narrow for their forecasts. Finally, the planning fallacy causes us to consistently underestimate timelines and overestimate outcomes. Recognizing these patterns in your own research is the first step toward building a more robust and realistic investment model. Anchoring occurs when we over-rely on the first piece of information we encounter. Whether it is a stock's 52-week high or your own purchase price, that number sticks in your mind and prevents you from making rational adjustments as new evidence emerges. You must learn to base your valuation on intrinsic data only. We see anchoring in analyst target prices, where experts move their targets insufficiently even when major revisions are needed. It also happens with round numbers, where markets react emotional to salience at levels like 10,000 on the Dow. The fix is to build independent models before reading external targets and to value every asset based on its current fundamentals, not on a float price or a historical high that no longer reflects reality. This independence is a hallmark of a disciplined investor. Following the crowd can feel individually rational in a vacuum, but it is collectively catastrophic. This is hurting, often driven by the fear of missing out, or FOMO. When everyone is talking about the same investment, retail inflows peak precisely at the cycle tops, right before the crash. Hurting is not just for retail investors. Professionals often benchmark hug to avoid career risk, preferring the safety of consensus over the risk of being a lone contrarian. Today, social media platforms like Reddit and Twitter accelerate this herding at unprecedented speeds, as seen in the GameStop short squeeze of 2021. To be a successful investor, you must have the conviction to stand apart from the crowd when the data demands it. even when the social pressure to join the herd is at its most intense. There are many other critical biases. Confirmation bias makes us seek only evidence that supports our thesis while dismissing contradictions. Mental accounting makes us treat prior gains as house money, leading to excessive risk-taking. These are the subtle errors that drain portfolio value over time. Other errors include the availability heuristic, where we overweight vivid recent events, and recency bias, where we extrapolate current trends indefinitely into the future. We also suffer from status quo bias, failing to rebalance out of a desire for comfort, and the framing effect, where the same information presented differently leads to opposite decisions. For example, a 90% survival rate sounds better than a 10% mortality rate. Recognizing these cognitive shortcuts allows us to slow down our thinking and make more deliberate, evidence-based choices in our investment process. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This is the core of the fear and greed market cycle. From peak euphoria to the depths of panic, understanding where we are in this emotional arc is essential for any contrarian investor. The cycle moves from optimism to euphoria, then through denial and fear into maximum panic. At the peak, retail floods in and valuations become extreme. This is your signal to sell. At the bottom, stocks are declared dead, and pessimism reigns. This is your signal to buy. We use indicators like the VIX fear gauge and the put-call ratio to track these extremes. A VIX above 30 often signals extreme fear and a potential buying opportunity, while a very low level suggests complacency and market vulnerability. These tools help us trade on data rather than emotion. 400 years of financial history confirm that the same pattern repeats across every major bubble. From tulip mania to the dot-com era, bubbles follow a predictable 5-stage model. Recognizing these stages in real time is what saves an investor from total ruin. The Minsky model starts with displacement, a genuine new opportunity, followed by a boom where credit expands. Then comes euphoria, where this time is different and valuations disconnect from reality. Distress follows as insiders sell quietly, leading finally to a panic and a rapid collapse. We've seen this in the Japan Nikkei bubble of the 80s, the US housing crisis, and recent crypto cycles. In every case, smart money enters rationally but is eventually overwhelmed by retail FOMO and unsustainable leverage. Learning these stages allows you to quantify the excess and identify the warning signals before the unwind happens. Understanding your biases only helps if you actually change your process. We must implement systematic, evidence-based interventions to protect our capital. This includes pre-mortem analysis, where we force ourselves to consider every way an investment could fail before we ever commit a single dollar. To build a deviate process, you should use a mandatory investment checklist and enforce a 48-hour cooling-off period between an idea and its execution. For anchoring, always perform a blank sheet valuation independently before looking at the market price or analyst targets. To combat recency bias, study 100 years of market history rather than just the last 3. Finally, require a written thesis for every trade and calculate all-in costs first. These hurdles are designed to slow down your emotional brain and ensure that every decision is filtered through a rigorous, rational framework. It is the only way to exploit the irrationality of others. Your ultimate deviating superpower is the investment journal. By tracking every decision in writing before you make it, you create a feedback loop between your prediction and the actual outcome. This is the most powerful antidote to overconfidence and the best way to improve your skill over time. Your journal should include your investment thesis, intrinsic valuation, and specific scenarios for success or failure. In emerging markets like East Africa, these insights are even more critical, as lower liquidity and limited information often amplify biases like information cascades and political anchoring. The best investors integrate these behavioral screens with rigorous fundamental analysis at every step, from management quality checks to the final investment decision. This holistic approach allows you to identify neglected stocks and exploit the systematic mispricings created by others' irrationality. It is about combining self-awareness with technical mastery. We have covered an immense amount of ground today, from the math of prospect theory to the psychology of market bubbles. Consolidating this knowledge through the activities and case studies provided is the best way to ensure you can apply these rules under the heat of real-time market pressure. Review the Module 8 quiz questions. Can you distinguish overconfidence from herding? Do you understand why losses loom larger than gains? Use the key concept summary to verify your mastery of the Minsky model and VIX interpretation. We have journeyed through the foundations of market psychology and built a systematic process to protect your portfolio. Solidify these lessons before we move on to Module 9, where we will focus on portfolio management and asset allocation. Your behavioral self-awareness will be your greatest asset as we begin building and measuring real-world portfolios. Thank you for following this course on behalf of SNB experts. I hope you found this session on Module 8 valuable for your development. Please subscribe to our SNB Experts YouTube channel for more modules and investment insights. Goodbye and see you next time.